One of the best investing lessons I ever learned came from a successful entrepreneur I admired growing up. When I first became interested in investing, I thought the secret was finding the perfect stock before everyone else discovered it. So I asked him, how do you actually choose good companies to invest in? His answer surprised me. He said, think about it like choosing long-term relationships. At first, it sounded strange, but the more I thought about it, the more it made sense. When you invest in a company, you're not just buying numbers on a screen, you're becoming a partial owner of a business. And just like relationships, some businesses are stable, trustworthy, and built to last ecosystems, while others look exciting at first but eventually become disasters. There's no magic formula that guarantees instant wealth, but there are ways to make smarter decisions and reduce unnecessary risk. If you're someone who's interested in learning and making money, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. So let me show you the simple framework beginners can use to evaluate companies intelligently. Before buying any stock, you need a clear strategy because different investing styles lead to very different outcomes. Some people trade constantly, trying to profit from short-term price movements. Others focus on owning strong businesses for years. These are two completely different mindsets. Technical trading. Short-term traders mainly study charts, patterns, and price movements. Their goal is to predict short-term swings. Some traders succeed, but the reality is that most beginners lose money because emotional decisions and market volatility are extremely difficult to manage consistently. Short-term trading can quickly become speculation instead of investing. Fundamental investing. Fundamental investing focuses on understanding the actual business. You examine revenue, profits, debt leadership, customer loyalty, long-term growth potential. Instead of asking, will this stock rise tomorrow? You ask, will this company still be stronger years from now? That's the approach long-term investors usually prefer. A balance sheet is basically a financial snapshot of a company. It shows what the company owns, what the company owes, and what remains for shareholders. The three main sections are assets. These include cash, equipment, buildings, inventory, and investments. Assets are valuable things the business owns. Liabilities. These are debts and obligations the company must pay. Examples include loans, unpaid expenses, taxes, short-term debt, shareholder equity. This represents the company's net value after liabilities are subtracted. A simple way to evaluate financial strength is comparing current assets to current liabilities. If a company has enough short-term assets to comfortably cover short-term debts, that's usually a healthier sign. The income statement shows whether a company is actually making money. It includes total revenue, expenses, operating profit, net income. Revenue is the total money the company brings in from sales. Expenses. Every business has costs. For example, production cost, employee salaries, marketing operations. Profit. After expenses are removed, what remains is profit. A company with healthy profit margins usually has stronger operational efficiency. But profitability alone isn't everything. Some fast-growing companies intentionally reinvest profits back into expansion for years before becoming highly profitable. Profit looks good on paper. Cash flow shows reality. A company can technically report profits while still struggling financially if cash isn't managed properly. Cash flow statements show money coming in, money going out, investments, financing activities. Strong businesses typically generate positive operational cash flow consistently. This means the company's core business is producing real money. You should also pay attention to excessive debt, unsustainable dividend payments, reckless spending. Good businesses manage cash carefully during both good and bad times. The numbers aren't everything. Not every important factor appears on financial statements. Some companies succeed because of things numbers can't fully measure. For example, brand strength. Strong brands create customer trust and loyalty. People naturally return to brands they recognize and trust. Leadership management matters enormously. A smart leadership team can guide a company through difficult periods and make strong long-term decisions. Competitive advantages. The strongest companies usually have something difficult to copy. Technology, patents, loyal customers, network effects, strong ecosystems. These advantages help businesses stay ahead of competitors over time. Don't panic during bad news. One mistake beginner investors make is reacting emotionally to headlines. When bad news appears, many people panic and immediately sell, but markets often overreact emotionally in the short term. Temporary problems do not always destroy great businesses. Long term investors focus on business fundamentals, future growth, long term resilience, not daily fear and headlines. That said, there are times to sell if your financial goals change, if you need emergency cash, or if the company's long term outlook genuinely weakens. Understand different types of stocks. Not all stocks behave the same way. Value stocks. These are usually established companies, stable earnings, lower volatility, dividend paying businesses. They tend to grow steadily over time. Growth stocks. Growth companies focus heavily on expansion. They often reinvest profits, grow rapidly, experience larger price swings. These stocks can offer higher upside, but usually with more risk. Many investors combine both styles for balance. Diversification protects you. One of the biggest mistakes beginners make is putting too much money into a single stock. Diversification reduces risk. This means spreading investments across multiple companies, industries, sectors, and even countries, because if one investment performs badly, others may help balance the portfolio. Investing isn't about getting rich overnight. It's about building wealth steadily while protecting yourself from unnecessary risk. The truth is, successful investing is usually boring. It's patience, consistency, research, emotional control, and long-term thinking. Most people lose money because they chase hype, panic during fear, or expect instant results, but the investors who win long term usually focus on understanding businesses and staying disciplined. And honestly, that simple mindset can change your financial future forever.